2 years ago, the world's most powerful companies made a collective promise. Artificial intelligence would redefine everything. Executives spoke of revolutions in medicine, finance, logistics, and creativity itself. Investors believed them. More than $10 trillion has poured into AI infrastructure, research, and startups since 2022, enough money to rebuild every major city in America twice. NVIDIA's stock rocketed from $150 to over $900, turning a chip maker into a $3 trillion titan. Microsoft spent $60 billion wiring data centers across the planet. Google, Meta, and Amazon followed close behind. They called it the dawn of a new industrial age. But beneath the glowing headlines, a quieter truth is emerging. The numbers don't add up. The returns are tiny compared to the burn. The power bills alone rival the GDP of small nations, and the profits, the thing every bubble eventually runs on, are nowhere to be found. The AI revolution may still come, but the boom driving it today can't last. Because every generation has its miracle technology that promises to rewrite reality. And every time, the math breaks first. In the next few minutes, we'll walk through the pattern that has ended every speculative era in history and see why the smartest minds in the world are repeating the same mistake. There's a rhythm to human innovation, an emotional cycle disguised as progress. It starts with invention, swells into euphoria, and collapses into reckoning. You can trace it like geological layers through history. In the 1800s, the railroad boom promised endless wealth. Investors built tracks across continents faster than freight could fill them. Shares soared, fortunes were minted, and then, when profits lagged, the panic of 1873 wiped out half the market's value. In the 1920s, radio was the new miracle. Dozens of broadcasting companies went public. Few earned a cent. By 1930, most were gone. Fast forward to the dot-com mania of 1999, eyeballs replaced earnings, valuations detached from reality, and when the crash hit, the Nasdaq fell 78%, erasing $3 trillion. A century later, Crypto 2021 repeated the dance. Coins with no cash flow reached multi-billion-dollar valuations before imploding back to dust. And now, AI in 2025 is following the same choreography, only this time, the numbers are bigger, the players richer, and the belief stronger. The cycle always begins with a kernel of truth. Railroads really did shrink continents. The internet really did change communication, and AI really can write, code, and analyze faster than any human. But truth isn't profit. When innovation outruns monetization, the gap fills with speculation, and speculation is jet fuel. Each breakthrough invites a new promise. This will transform every industry. Soon capital floods in, chasing exponential returns that can never exist in the real world. Infrastructure spending explodes, stock prices detach from earnings, and executives justify it all with the phrase, future potential. Then, reality intervenes. The technology works, but not at the scale or the speed investors imagined. Revenue lags, margins collapse under operating costs, and as soon as growth slows, confidence evaporates. Every bubble pops in silence first, when insiders quietly stop buying the story they helped create. That's where the AI era now stands. For 2 years, Wall Street and Silicon Valley have treated AI as destiny. The narrative was bulletproof. Intelligent machines would revolutionize everything, and whoever spent the most would win. But history suggests the opposite. The winners of each revolution aren't the biggest spenders. They're the survivors who buy assets after the crash. Amazon and Google rose from the ruins of the dot-com bust, not during it. So if the pattern holds, the true AI giants of 2030 haven't been crowned yet, and the empires spending hundreds of billions today may be tomorrow's cautionary tales. Because while every generation thinks its bubble is different, the chart always looks the same. Exponential ascent, euphoric plateau, then the long slide back to reality. The warning signs are already visible. Investments in data centers and chips are outpacing potential revenue 20 to 1. Energy demands are straining national grids, and valuations assume flawless growth for a decade straight. Markets call that priced for perfection. Perfection never arrives. When it doesn't, the correction feels instant. That's why historians see AI 2024 as the mirror image of .com 1999. Breathtaking innovation, unsustainable economics, and investors convinced they've outsmarted every generation before them. They haven't. The scale of AI spending over the past 3 years is unlike anything in corporate history. It isn't just venture capital or hype. It's concrete, steel, silicon, and electricity. In 2023, global companies spent an estimated $200 billion on AI infrastructure alone. Data centers, cooling systems, specialized chips, and power lines dedicated to training large models. By 2024, that number ballooned to $350 billion, and projections for 2025 exceed $400 billion. Nearly $1 trillion in physical infrastructure in just 3 years, before counting research, acquisitions, or software development. These aren't abstract investments in the future. They are tangible, energy-hungry fortresses of computation. At the center of it all is NVIDIA, the company that became the arms dealer of the AI revolution. It doesn't build data centers or rent cloud space. It sells the hardware everyone else depends on. In 2022, NVIDIA's data center revenue was $15 billion. By 2023, it soared to $47 billion. In 2024, analysts projected it would pass $100 billion, a seven-fold jump in 2 years. Each H100 or H200 GPU sells for $25,000 to $40,000, and major buyers purchase them by the tens of thousands. A single AI training cluster can cost $500 million to more than $1 billion, and most tech giants are building several at once. That means billions of dollars poured into chips that begin depreciating the moment they're switched on. Microsoft has been the loudest spender, with more than $60 billion directed toward AI infrastructure in just 2 years. That includes new hyperscale data centers, custom power systems, and a $13 billion stake in OpenAI. Google has committed around $50 billion, developing its own TPUs while still buying NVIDIA hardware. Meta follows with $40 billion, building AI capacity to feed its advertising algorithms and its underperforming metaverse vision. Amazon, through AWS, has spent over $30 billion, blending AI development with cloud expansion. Collectively, the Big Five, Microsoft, Google, Meta, Amazon, and NVIDIA's other clients, have spent more than $300 billion in just 2 years. This is not innovation measured in prototypes or pilot programs. It's a full industrial build-out. Yet, the returns don't match the intensity of the investment. The assumption driving all this spending is simple. The more power you add, the more value AI creates. But value doesn't scale with voltage. When every company races to outspend the next, the outcome isn't shared prosperity. It's a debt-fueled arms race with no guaranteed payoff. Each new data center project requires its own substation, its own cooling lakes, its own dedicated fiber lines. The world is running out of space and power to sustain the dream. The AI economy has become less about intelligence and more about capacity, measured in megawatts, megabytes, and megadollars. The question no one on Wall Street wants to ask is the one that will define the next decade. What happens when the bill for this trillion-dollar infrastructure comes due and the revenue isn't there to pay it? For all the billions being poured into AI infrastructure, the payoff remains painfully small. The world's most powerful companies are betting on a future that still hasn't arrived because the revenue simply doesn't justify the cost. Take OpenAI, the company that ignited the modern AI boom. By late 2024, its annual revenue hovered around $3.5 billion, up from $1 billion the year before. Impressive growth, but not enough to offset the expense of running massive language models. Reports suggest OpenAI spends over $5 billion per year on compute alone, most of it paid to Microsoft Azure. That means the company is losing roughly $2 billion annually, even as its valuation sits at $150 billion, a staggering 43 times revenue for a business deep in the red. It's a paradox only a bubble can sustain. Microsoft, which has integrated AI into nearly every corner of its ecosystem, from Copilot in Office 365 to Bing Chat and Azure AI services, faces a similar imbalance. The company has spent about $60 billion on AI infrastructure, but the revenue attributed directly to AI products adds up to perhaps $10 to $15 billion a year. Even at the higher estimate, it would take 4 to 6 years just to break even, assuming costs don't rise and demand doesn't slow. Both of those assumptions are already under threat. Over at Google, the story isn't much different. The tech giant spent roughly $50 billion on AI development and infrastructure. Its Gemini platform competes directly with ChatGPT, but much of it is offered free to users, an enormous cost center with limited revenue return. Analysts estimate AI contributes maybe $15 to $20 billion annually to Google's business, primarily through ad optimization and cloud services. That means another 3 to 4 years before breaking even, and even that's optimistic. Giving away $1 billion product just to protect market share is not a sustainable business model. It's a defensive one. Meta spent over $40 billion combining its AI projects with the costly Reality Labs division, hoping to create synergy between machine learning and virtual environments. Yet, most of its consumer-facing AI tools, like the Meta AI assistant, remain free and unprofitable. Amazon invested about $30 billion into AI-driven logistics, Alexa, and AWS AI services, generating perhaps $10 to $15 billion in return. But Alexa, even after nearly a decade, still operates at a loss. Billions every year. When you combine the 5 tech titans, Microsoft, Google, Meta, Amazon, and NVIDIA's customers, their $300 billion in AI spending has generated only about $60 to $80 billion in annual AI-related revenue, much of it from old products dressed up with new labels. That's a 20-to-1 ratio between investment and return. And in technology, that's not innovation, it's imbalance. Even worse, the growth is slowing. ChatGPT subscriptions have plateaued, Copilot's user base has stalled, and enterprise adoption remains cautious due to high costs and privacy risks. The math no longer works. Billions in capital have been converted into servers, chips, and hype, but not profits. The dream was to build machines that think. The reality is an industry struggling to justify its own intelligence. Artificial intelligence truly works. It can write essays, generate code, summarize legal documents, and create images with breathtaking accuracy. But capability doesn't automatically equal profitability. The real challenge for this trillion-dollar movement isn't whether AI can do impressive things, it's whether anyone will pay enough for those things to justify the cost of building and running them. Right now, the answer is no. Most AI products target individuals and small businesses with prices between $10 and $30 per month. ChatGPT Plus costs $20. Microsoft Copilot sells for $30. Google One AI Premium is $20. At those price points, companies would need hundreds of millions of paying users just to cover infrastructure costs. Yet the real subscriber base is a fraction of that. ChatGPT has about 10 million paying users, which brings in roughly $2.4 billion a year, still far short of its operating costs. Enterprise adoption, once touted as the golden path to profitability, is proving slower and more complicated than expected. Businesses face high integration costs, strict data privacy regulations, and resistance from employees who see AI as a job threat rather than a tool. Studies like one from MIT found that AI coding assistants improve productivity by around 26%, useful, but not revolutionary. A 26% gain doesn't justify spending hundreds of billions on new infrastructure. For most companies, AI remains a supplement, not a transformation. Then there's the consolidation problem. Once a user has access to one strong general-purpose AI, like ChatGPT, Gemini, or Claude, they don't need 5 others. The market naturally collapses around 1 or 2 dominant platforms, leaving hundreds of startups fighting over scraps. That makes AI a winner-take-most industry, where the upside is enormous for 1 or 2 players, but devastating for everyone else. The irony is painful. AI is powerful enough to change workflows, but not profitable enough to justify the spending frenzy behind it. The technology is real, but the total addressable market, the TAM, is far smaller than investors imagined. What looked like an infinite goldmine is, in truth, a narrow stream with too many miners. If there's one truth hidden beneath the AI boom, it's this: intelligence is expensive. Running large language models isn't like hosting a website, it's like powering a small nation. Training GPT-4 alone cost over $100 million in compute, and that's before factoring in inference, the ongoing cost of running it for billions of queries each month. Every time a user asks ChatGPT a question, it costs between 1 and 4 cents in processing power. Multiply that by billions of requests, and the math spirals into the absurd. At even 10 billion queries per month, OpenAI burns through $100, $400 million monthly, or up to $5 billion per year, just to keep the servers running. The hardware arms race fuels this problem. Companies keep building bigger models to stay competitive, but each generation costs exponentially more. GPT-5 will likely cost more to train and operate than GPT-4, just as Google's Gemini Ultra costs more than Gemini Pro. The trend line points in one direction, up. Efficiency gains from NVIDIA's next-gen chips can't keep up with the sheer size of the models they're meant to power. The result is a cost spiral where progress depends on spending ever more money for marginally better results. Then there's the energy. A single NVIDIA H100 GPU draws around 700 watts at full load. A mid-sized AI training cluster uses roughly 10,000 GPUs, pulling 7 megawatts continuously. Scale that up to the mega clusters being built by Microsoft, Amazon, or Google, 50,000 to 100,000 GPUs. And you're talking 35 to 70 megawatts, 24/7. That's the output of a small power plant dedicated entirely to one data center. At commercial electricity rates of 7 to 12 cents per kilowatt hour, one facility can rack up $150 million per year in electricity costs. Cooling alone adds another 30–50%. By 2027, analysts expect AI data centers to consume more electricity than entire nations such as Argentina or Sweden. It's a paradox the industry refuses to confront. The smarter the machines get, the dumber the economics become. Scaling intelligence at this pace isn't sustainable, financially or environmentally. The future of AI won't be limited by imagination, it will be limited by the power grid itself. Every bubble is defined by one number. The multiple investors are willing to pay for hope. In the AI boom, that number has reached insanity. NVIDIA, once a niche chipmaker, now trades at a price-to-earnings ratio of around 65, meaning investors pay $65 for every $1 of profit. Historically, anything above 25 signals danger. Above 50 means delusion. NVIDIA's market cap has already surpassed $3 trillion, built entirely on the assumption that companies will keep spending hundreds of billions a year on AI hardware indefinitely. If that spending slows even slightly, the foundation cracks. The same pattern holds across the tech sector. Microsoft, Google, and Meta have all seen their valuations expand not because of earnings growth, but because of AI narratives, the promise of a future cash flow that doesn't exist yet. Analysts call this priced for perfection. It means every projection, every quarterly report must deliver flawless growth. But perfection never survives contact with reality. When revenue growth misses by even a few percentage points, the fall is violent. In speculative markets, optimism compounds on the way up and evaporates twice as fast on the way down. Investors are betting on a perpetual motion machine, that rising demand for chips will justify rising prices for chip makers, which will justify even more investment in AI. But that logic loops back on itself. Once companies stop spending, the entire chain snaps. NVIDIA's revenue collapses, data center orders dry up, and investors realize they were paying tomorrow's prices for yesterday's growth. Markets have seen this movie before. The charts from 1999 dot-com stocks and 2024 AI leaders are nearly identical. Vertical climbs, irrational valuations, and a single fragile assumption holding everything together. That this time, it's different. It never is. Every bubble ends the same way. One event breaks the illusion, and confidence evaporates overnight. For the AI boom, there are 3 possible triggers, and each is already on the horizon. The first is visible failure, when a major AI company implodes under its own weight. It could be a high-profile startup that burns through billions and shuts down, or a tech giant forced to write off tens of billions in AI investments that never paid back. History shows what happens next. Lehman Brothers in 2008, Pets.com in 2000, each collapse shattered faith across entire sectors. When a flagship falls, panic spreads faster than reason. The second trigger is stalling growth. When investors realize the promised exponential revenue isn't coming, the exit begins. That's already visible. ChatGPT's user base has plateaued, Copilot's adoption has slowed, and Gemini's launch failed to ignite a surge in paying customers. Once those stagnation headlines hit earnings reports, when Microsoft or Google are forced to admit that AI revenue isn't meeting expectations, the narrative turns. Hype becomes hesitation. Stocks priced for perfection can't survive disappointment. The third trigger is cost exhaustion. AI's hunger for energy and hardware has pushed spending to unsustainable levels. When CFOs start cutting budgets, chip orders shrink, data center projects pause, and suddenly the entire ecosystem contracts. NVIDIA's sales drop, startups run out of funding, and the domino effect accelerates. Economists call this the doom loop. Less spending leads to lower revenues, which lead to more cuts, which lead to collapse. The signs are already blinking red. The only missing piece is timing. All it takes is one spark, a failed IPO, a disappointing quarter, or a major power grid crisis, and the trillion-dollar illusion turns to dust. If history is any guide, bubbles don't burst all at once. They unwind in slow motion, year by year, as optimism turns into realism. The AI timeline is already tracing that curve. In 2025, the growth still looks unstoppable. Companies continue announcing new AI partnerships, new chips, and new models. Spending increases, but slower, 20% instead of 50% year over year. Investors begin to notice, but they tell themselves it's just a breather. Then comes mid-2026. The cracks widen. Earnings reports start to reveal what the hype had hidden. AI revenue isn't meeting projections. Microsoft's Copilot subscriptions stall, OpenAI's losses grow, and Google's Gemini struggles to convert free users into paying customers. Stock prices dip, executives insist long-term fundamentals remain strong, and analysts quietly cut their targets. The first layoffs begin. By 2027, denial gives way to panic. The AI bubble pops. Venture capital dries up. Startups fail en masse. And the market realizes that $10 trillion in capital has been chasing maybe $500 billion in real opportunity. NVIDIA stock falls 50% to 70% from its peak. Data center projects halt halfway through construction. The giants survive, but scarred. Microsoft, Google, and Amazon take $30 or $50 billion write-downs on depreciated infrastructure. What was once the AI revolution becomes a corporate embarrassment. Then comes the quiet stage, 2028 and 2029, the bottom of the cycle. The hype is gone. What remains are the practical survivors. companies integrating AI into existing profitable businesses instead of treating it as a standalone gold rush. The industry consolidates, stabilizes, and begins to rebuild on real economics. Doesn't vanish, it matures. The machines stay, the mania fades. In hindsight, the boom will look inevitable, and so will the crash. Because that's how every revolution becomes reality. First worshipped, then forgotten, finally useful. When the dust finally settles, the AI landscape will divide into two worlds: those who built castles on speculation, and those who built tools people actually use. The casualties will be easy to spot. AI startups that raised billions without revenue models will vanish first. Companies offering chatbots, image generators, or generic productivity tools with no defensible moat will be swept away. Most of them have already spent their funding on compute and salaries, hoping to scale later. When capital tightens, they'll discover there is no later. 90% of AI startups will fail, not because their technology didn't work, but because it didn't earn. The second wave of casualties will hit mid-tier players, those who rely entirely on cloud subsidies or API reselling. When costs rise and enterprise clients demand discounts, margins disappear overnight. Some will be acquired for pennies by larger firms looking to salvage their talent or intellectual property. Others will simply shut down, their servers powering off quietly as investors move on to the next trend. But not everyone dies. A handful of survivors will emerge stronger. The winners will be companies that tie AI directly to existing profit centers, where machine intelligence enhances an already valuable business instead of trying to become one. Microsoft, Google, and Amazon will survive because AI lives inside their core engines: search, ads, and cloud computing. These businesses generate real cash flow, allowing them to absorb short-term losses and still dominate the infrastructure layer. NVIDIA, despite a brutal valuation reset, will remain essential. Its chips will still be needed long after the hype cools. And beneath them all, new specialists will rise: open-weight model developers, on-device AI pioneers, and vertical systems built for high-value fields like medicine, defense, or compliance. These niches don't need millions of users. They need a few clients willing to pay millions. When the bubble bursts, the lesson will be simple. The AI companies that sold dreams will disappear. The ones that sold results will survive. In every era of innovation, there's a moment when the dream collides with the balance sheet, and reality always wins. Artificial intelligence isn't a scam, and it isn't going away. It will continue to shape industries, automate tasks, and expand what humans can build. But revolutions don't happen because of trillions spent or headlines written. They happen when technology becomes quietly indispensable. That's what's next for AI. The hype will fade, the valuations will fall, and the noise will die out. What remains will be the real value, the models and systems that make life or business meaningfully better, not just impressive in a demo. When historians look back, they won't see the AI boom as a failure. They'll see it as a necessary correction, the price humanity pays to separate illusion from infrastructure. Just like the internet, electricity, and the railroad before it, AI will become something ordinary, something boring, something essential. The $10 trillion Mirage will evaporate, but intelligence, machine or human, will still endure. The only question is who will have the patience to stay after the applause ends.